היי, ברוכים הבאים לפרק השמיני והאחרון בסדרה הזאת כרגע של הסיפורים האמיתיים מאחורי האקזיטים. אני חושבת להגיד שזה אחד הפרקים הכי מעניינים, אם לא הכי מעניין שיצא לי להקליט בסדרה, מזווית לגמרי שונה של אקזיטים. אז אחד הדברים שככה מאוד הפתיעו אותי, שהתחלתי לדבר עם אנשים על הנושא, זה המעורבות של מה שנקרא בנקרס, כלומר מתווכים בעסקאות. הסיבה שזה מאוד הפתיע אותי זה כי בעולמות שאני מכירה הרבה יותר טוב, של גיוס הון, בנקרס נחשב משהו די שולי, כלומר לבוא עכשיו לגייס הון עם בנקאי, נראה בדרך כלל פחות טוב, זה משהו שלא כל כך עושים ברוב המקרים, והפתיע אותי מאוד לגלות עולם אחר לגמרי בתחום של הרכישות. שדווקא שם, בגלל שהחברות הגדולות פחות בקשרים עם סטארט-אפים, ובגלל הרבה סיבות שנדבר עליהן בשיחה עם דון מור, שהוא הבנקר שהצטרף לרעיון עוד מעט, והיה מעורב במחירות של הרבה מאוד חברות, ובכמה חברות סייבר ישראליות. זהו, והוא בעצם מספר לנו מתי עובדים עם בנקר. אחד הדברים שמאוד מעניינים לשמוע זה כמה בנקרס בדרך כלל כן מעורבים בעסקאות כאלה. כלומר, הוא מעריך ש50% מהעסקאות של האקזיטים כן מערבות בנקר. איך חברה יכולה באופן אקטיבי לפנות לחברות אחרות דרך בנקר, מתי עושים את זה, מה הפרמטרים שלפיהם הוא בוחר אם לעבוד עם חברה או לא, תוך כמה זמן הוא מבין אם הולכת להיות פה עסקה או לא, או לכמה חברות פונים. זהו, ועוד המון פרטים מעניינים עם דון, שכבר נתחיל את הרעיון איתו.
Okay, so hi, today I'm here with Don Moore. So far I interviewed entrepreneurs and people from M&A teams, and I guess it's like at least in like half of the episode, the term banker came up. Some of the companies mentioned that they assisted the banker to get to the potential buyers, to close the deal, and Don is a banker. And today we're going to hear his perspective and to understand what a banker is, when would you like to approach a banker. So Don, the stage is yours. If you can introduce yourself.
Sure. I'm a banker at a boutique firm in the U.S. called JMP. We're headquartered in San Francisco, and I've been a banker for about 20 years, and I spend most of my time in cybersecurity, which is a very active area. I think the definition of banker depends on the situation, but it always entails either facilitating a transaction or trying to generate one. Generate a transaction means there's no interest on the table. There's a company that decides it wants to raise money or it wants to find a partner. So we help try to find that. And then facilitating means helping to close the deal once there's interest. And sometimes I get brought in when there is interest already, and sometimes I'm brought in when there's none at all. It just depends.
Mm-hmm. Okay, so one thing that I know about bankers, and they're really like interested to know if I'm right or not, is that you usually approach a banker either for like a fire sale, and the company is not doing well, this might be the time for exit, or if everything goes amazingly well, or you have like one company that is already interested in acquiring the company and you want to generate more offers. So I would love to hear your perspective, like when is like the typical use case in which companies approach you. Yeah.
I think bankers tend to be helpful where there is a decision point to be made, meaning there has been interest expressed in the company, or the company is growing and needs to raise money. And those are decision points where sort of banker could help drive to a better conclusion. I think bringing on a banker, it doesn't typically have to have a sort of a negative connotation. In fact, in cyber, most of the deals I do are very high multiples because cyber is a very expensive market. And for example, recently I did a deal in Israel with Cisco, and the seller actually didn't have any interest on the table, but they were going to raise a round. But if they raised a round, it would make the business much more expensive for the buyer in the future. So we use that as the point to talk to strategics and to tell them, look, there's an amazing business. The business is about to be, about to raise money. But if you're interested in an acquisition before that, there's an opportunity for a much more cost-effective transaction. I would also say that if you're active in a market, if you talk to buyers or investors, if a banker is calling, then there's probably something going on. So it's not a bad connotation unless the company's really not doing well. In that case, it can be a fire sale, but I've done very few fire sales because those are very hard to do. So it should be a company that is confident about their growth prospects. Doesn't matter if it's early stage or late stage, and a company that I can at least articulate a decision point to drive the timing, right? So I could say the company's going to raise money in 2 months, so we need to get a term sheet from you by then, or we're expecting a strategic buyer to submit a term sheet in a month, and so you need a forcing function from a timing standpoint, and if you have that, it makes the process a lot easier.
Yeah. So I'm really interested at the scenario that you just described, because I think that this is the place that most entrepreneurs are at most of the time. So things are going okay. It's not that we have like tons of different offers right now, but we are looking for other options, and I fully agree that the point in which you need to decide whether you're going to raise the next round and the valuation is going to double, triple, or even more, and then you're going to have less potential buyers is a very critical point. When you approach the acquiring or the potential acquiring companies, how do you usually present it? Because I would say that probably in most cases things are going okay or pretty good, not the most successful company ever.
So look, the reality is when you're talking to potential buyers, you're marketing, right? So you're not going to, present in a way that diminishes from the attractiveness of the business. And the reality is that as a standalone company, you may be doing okay, but quite often the only thing that's holding you back is distribution, meaning salespeople, market presence, brand, complementary product. So if a strategic buyer has that, then the fact that you're small or that you're not growing 300% a year doesn't really matter. It's really the team and the technology, at least in my space, but more broadly in technology. So, I've been on late stage and early stage deals, but I've been on multiple early stage deals where literally it's 15 people and a dog, and there's almost no revenues, but there's a believable vision and an opportunity. And the reality is, if you look through the history of public technology companies, once they go public, very few of them ever actually design a new product. They go public on the basis of a monster product that's doing great. They're really good at marketing and distribution, sales distribution. They're not good at development. So they would rather often find someone that has taken the risk, develop the product, and then pick it up and run from there. So you'd be surprised. I mean, if you look at a company, you'd say, wow, this looks interesting, but it's just an idea. And an extreme example of that, by the way, on the fundraising side, if you look recently at Wix, which raised $100 million on a PowerPoint, or if you go further back, CrowdStrike, which is a very successful public cybersecurity company, they basically pitched to Warburg, a large investor, a story with no revenues, no product, but the vision and the credibility. And if you have that, that's often enough. It's better to have the product to have customers, but it's more important to have the right team and the right product. Revenues are great as evidence, But as you get to late stage, it's less about the product and it's more around the revenue and the cash flow. So,
yeah. Yeah. When you're being approached by a company, how do you decide if you want to work with them or not?
That's great. That's a great question. It's called the 3 T's, or the 3-legged stool. It's team, TAM, and technology. So team, right? So when you sign up the Beatles, you're signing up the bands, right? You believe that they're the band that's going to make a lot of money. It's the technology. You have to assess that there's a realistic chance of success. The technology is attractive and real. It's not just a pipe dream. And the third thing is TAM, which is total addressable market, right? So if it's a market where investors or buyers are seeing a lot of pull, and so you don't always have all 3. You want to have at least 2, but ideally, if it's an early stage company, you want to have all 3 of those things. When you get later stage, it's a lot more about the sales momentum, right? So the product is out there are customers. Is it growing? And if it's not growing, you know, it becomes a difficult question, because once you've actually entered the market, you want to grow as quickly as you can. And I'm not talking about like, you know, car manufacturers or, you know, potato chip companies where it's all about the cash flow. I'm talking about real kind of cutting edge momentum companies. So you either got to have the 3 T's or you got to have a lot of momentum. But even if you have momentum, you still want to have the 3 T's. So, you know, with PortShift as an example, I'm not sharing anything confidential, but they address the space in cloud security that is very large. The team was amazing, you know, 8,200, a lot of smart people. And then the product, there were a few lighthouse accounts where the companies used the product and loved it. So when you have all 3 of those things, it really makes it actually quite easy. And then it's just a question of how do you maximize value, which is another question. But so I've actually never taken on an assignment that did not result in offers, because over time you get pattern recognition and you could tell, like, this is just not going to fly, or it is. I've been wrong before, but I've been fortunate. Everything I've taken on has gotten to term sheet, and most of those things have closed. When they don't close, it could be, you know, due diligence, the market changes, the buyer, something happens to the buyer, but you can usually see the pattern and understand, like, this is going to be the next kind of star. So.
If it doesn't close, would you say that it's something that can damage the company? Because I think that entrepreneurs are usually worried that maybe it's not the right time to reach out to potential acquirers because maybe it's too early. And so I'm just interested to hear your opinion. So let's say, for example, that a company either by themselves or with a banker start reaching out to some companies, how it's going to look like. Or do you think that this is a great way to start building a relationship, and maybe in a few years from now it's going to it's going to grow to and become an interesting deal?
Yeah. So if you run a process in a traditional way, which you sometimes do with an auction, and you announce to the world that you're on the market. I mean, literally sometimes companies will make an announcement that they're looking at strategic alternatives. If you do that and you don't sell, it does create a question mark in the market. But especially for the early stage growth companies, if you pursue what I call a non-process process, where when you talk to potential buyers or investors, mostly buyers in my case, the message is there's no process here, but Cisco, I think you should really look at this opportunity because I know that you're into cloud security. You've told me this, and there's an amazing company. There's interest building around that business. They're looking at it raising around, you know, they're not in a process, but I think you should talk to them. And if you do that, once you have enough interest, then you could flip and say to those parties, okay, I know you said you're interested. There's other interest. Now we're actually going to pursue a quick process to select the party and do a deal. But you sort of do that once you know you have interested parties on the table. The downside to that approach, Iris, is that folks might not move as quickly. If they have a written deadline and it's a process, it's very clarifying. So it's very important to have this forcing function where you could say there's no process, but things are developing quickly, but they're going to raise a round, and then if nothing happens, there was no process. And in fact, often in the earlier stage deals, I would help prepare the materials of an investor deck, but it wouldn't look like I prepared it. The company would use their style. There would be typos. It won't have the logo of a bank. It'll look like a CTO kind of pulled something together with a co-founder, and it looks authentic. It's so important to be genuine and authentic. Otherwise, people will think you're trying to, put lipstick on the pig. I don't like that expression, but that's kind of the perception. So you need to be casual about it.
Yeah. If you had to estimate how many of the M&A deals, in your opinion, involve a banker? So how many happens with a banker as opposed to deals without a banker?
Fundraising or strategic or both, Iris?
Is a M&A.
M&A, yeah, strategic.
Yeah.
I would say not enough. I would like to say everybody should hire a banker. But the reality is, I think in my market, probably half of the deals don't involve a banker. And that's fine. It's because there's a negotiated process. More often than not, your buyer in that case is someone that you're a partner with, right? If you're already selling through that partner, they're more likely to be your buyer, and they know them, they know each other, and the seller doesn't want a process, doesn't want a delay, doesn't want to lose the momentum, and so plenty of deals get done that way, and that's fine. But it's an equal number don't. I'd say that the advantage of a banker is, and it's not a commercial, but honestly, the banker, like the reason why bankers are now specialized, like when I started years ago, you had a generalist covering San Francisco, you had a generalist covering New York, and it sounds kind of silly, right? The same banker will do a cyber deal and will do a cosmetics transaction. It just doesn't make sense because you need to understand the dynamics of the business, and also you need to understand the buyers. So if you have repeat interaction with the buyers, they know you. So one thing a banker can do is get you in front of those buyers in a credible way more quickly with less work. And then once you have interest, the buyer can be the person that negotiates and gets the deal done. You generally don't want to directly negotiate with your future employer because, you're going to have some tough conversations, and you as the company, as the seller, don't want to be directly involved with that as much as possible. So the banker can do that, and the banker generates competition. So, for those reasons that's where a banker works. Although, there's plenty of times where, again, because the pre-existing dynamics of a relationship, it's just a no-brainer just to do a deal. So the worst outcome is to use your lawyer or accountant as the banker. It's just, there's a conflict of interest. They don't know what they don't know about the buyers, about processes. They're very important as part of the process, but just as you don't want your grocer to be your surgeon, you don't want your accountant or your lawyer. No offense, I'm a former lawyer, but you don't want them to play the role of banker.
Yeah, I see. And would you say that the main value of the banker is opening the doors for the potential acquirers, or is it more around the process itself and making sure that there's a good progress?
It's all of the above. I mean, you want to open the door to the buyers, and also you want to help progress things as quickly as possible. There's a saying, time kills all deals. So once you are talking to folks, you want to do it as quickly as you possibly can. It's better for the company, and it's better for the process. When people stop, they start to think about all the things that could go wrong. they start to think about lunch, they start to think about other things. So you want to move very quickly with those buyers. So they're not, you know, once they fall in love, you want them to sort of keep moving and keep moving. And so a banker should be good at kind of keeping that rhythm and making things move very quickly. So.
Yeah. And how many companies do you usually approach when you start working with a new company? So like, for example, an entrepreneur I spoke with told me that when they decided they want their company to be acquired, they started working with a banker, and he created a list of 50 companies. They eliminated about 20 and they approached 30. To me, it sounds a lot. So I'm just interested if it's like, if you usually try to target only like the top 3 or 5, or do you usually try to open up all the different options as much as possible?
Yeah, if it's not a negotiated process, Iris, where you have interested parties on the table and you just want to try to get the right one at the right value, it's probably about 20. Because if you think about it, in a specific space, there's a certain number of buyers. Only a certain number of those could afford. Only a certain number within those could act in the short term, and only a certain number of those would pay a certain price. And so you sort of slice and dice it, and then you end up, if there's more than 20, either it's a very broad offering, or you're sort of throwing stuff on the wall and trying to figure out, you know, there are reasons where, I mean, I've done 50, I've done 70, but there has to be a reason. I mean, certainly nothing ventured, nothing gained, but if you're just out there with not knowing the specific reason why you're contacting someone, then you're irritating the buyer, you're wasting time. And the other thing is, you know, some clients want to have as many meetings as possible. And I don't think that's a good idea. Number one, you're exposing yourself, you're exposing your technology. Number two, it's a time waste. And number three, the number of meetings doesn't correlate necessarily with success, right? Because it's better to have 5 meetings with highly qualified, highly interested buyers than 20 meetings, right? But that said, if you're editing it and you're curating it right, if you have 20 tier 1 buyers, you have a rationale for each, you probably should get at least half or more than half to sign a non-disclosure, to look at some materials, to talk to the client, and from those you should probably have another half that are serious, and from that you should have at least half of those put in a bid, right? So if you're careful and you have 20 names, you should get 3 or 4 offers. I've been on deals where it's lower, I've been on deals where it's higher, but if it has those 3 T's, that kind of is predictable, and you should know that. You should know if the dog hunts like a month into the discussions. The deals don't close in a month, but you should know if this thing has legs, you know, within a month.
Okay. And I'm wondering to hear your opinion about, I know it's usually with fundraising, using a banker is pretty weird. So usually it's not considered, like if I want to approach a VC and they'll do it via a banker, it usually says like something is wrong. Maybe if it's, I think like all stages. And so I'm just wondering, why do you think it's very different with strategic deals, where you said that like probably like 50% of the deals involve a banker, where I would say that with fundraising, it might be like 5% of the deals. I think so. I don't have the numbers.
Right. Yeah, no, you're right, Iris. Very late stage, like if it's a late stage company, profitable, it's just a matter of getting as many people to the table and orchestrating a process with data room and all that. So late stage, if you're raising at least, you know, 100 million, later stage, even that, if it's a small company, you don't use a banker. But if it's a big company, a big raise, then it's more common. But VCs are very proud that they can find stuff themselves. They're very networked. And if they're not aware of a company and it was brought to them under the auspices of a banking process, they're like, this is probably not that good, because if they could raise money, they wouldn't need a banker. So there are exceptions to every rule. And, you know, making informal introductions is fine, right? You know, I have a friend at Shasta, and we talk, and she told me, hey, you know, by the way, we're interested in this kind of company. And then you know, it has to be very natural, but the VC has to feel it came through their own network, not presented from an outside banker. It's viewed as suspicious. Also, if you are a San Francisco-based early-stage company and you're raising money in New York with or without a banker, that's suspicious too, because people in New York will say, you know, why can't they raise money in San Francisco? For Israeli companies, they have the ability to raise money in San Francisco, in New York, in Boston, in Austin, anywhere, because that's not considered. But you also have to think about where do companies normally raise money, right? So, but yeah, so I think most VCs say, like, I know my network, and I know, and if someone presents to me, it's probably, you know, the founder should be talking to me directly. You know, I don't really need a banker. So.
Okay. So you said it's more
different
about
with a change of control.
Yeah. So you say it's more about the culture and less about the need.
Yeah, I think that's right. Right. I mean, yeah, I think, like, you know, you have a founder that goes up and down Sand Hill Road, and that founder will not have a banker. That founder will just come and stop in, have coffee, and share, you know, meet at a coffee shop. And it's just not, unfortunately, it's not done. I mean, I would love to be on all these raises, but it's just not done. But it is very different on a strategic process. So.
Yeah. And you mentioned before that you worked with a few Israeli companies and closed a few deals of Israeli companies. How much impact do you think that being an Israeli company that let's say 100% or 90% of the team is based in Israel, how much impact does it have on deals with companies that don't have a center in Israel?
So in my world in cyber, it's 99%, it's a big plus, because most enterprise companies with interest in cybersecurity or infrastructure software either have a development center in Israel or they want one. So it's a huge, huge plus. More generally in technology, it's also a plus as well. We sold a company to, I don't know if you know Grubhub. It's a, you order, I don't know if you have in Israel, but it's like you order food over the internet and they deliver it to you, right? And we sold a Israeli version. You have it too. I don't know if it's, but we sold an Israeli one called Topingo, and but it's basically food delivery via the internet. So you'd say, well, food delivery, you know, Grubhub, you know, do I need an Israeli company? But even there, they were like, wow, you know, Topingo does things in a really smart way with AI. So they bought it. So I think in most tech sectors, being in Israel is a huge, huge advantage. From an investment standpoint, investors looking to invest overseas also, I mean, Israel, as you probably know, Iris, raises a lot more money for tech than any European country. Yeah. So after the US, I mean, for tech, it's really Israel. And it's just the perception, which is accurate, that, you know, smart people, easy to work with, you know, all the positives. And, you know, Insight Partners is a very large private equity VC in New York. And the first office they opened outside of the US is in Israel. And you see it time and time again because of that strength. So it's you're in a very favorable environment.
Okay. And would you say it's an advantage or a disadvantage to have the CEO in the US? I can share it, like, with my experience with my first company was acquired by Autodesk. It was the first acquisition of Autodesk in Israel. And me and my partner, my co-founders, we were just about to move to the US. Then the company was acquired, and then they told us, please stay in Israel because we want you to manage the R&D center. So I'm interested to hear your opinion, because I do think that in many cases they want someone nearby and they want someone to help them with the communication, but they also want someone who will be in charge of managing the R&D center and the acquisition and the new center of the company.
Yeah, that's a great question. I'd say investors typically in the U.S. like to have a U.S. office because that way they can meet in person. At least the theory is they can meet in person more easily. Yeah. And also the company is signaling that they're going to grow in the U.S. market, which is the biggest market. For strategics, it's not usually the case because what they're interested in, at least in my world, is in the technology and the capable people. And so they don't care so much if there's not an office in the U.S. So it's really more on the investment side is my experience.
Okay. And you mentioned before we discussed like early stage companies, but also companies that do have revenue and need to show momentum. What would you say is a good momentum? Like not an incredible one, but where companies should aim to be named as a company with a good momentum?
Yeah, I think it's hard to cut it finely, but if let's say you're sub $5 million in revenues or ARR, you want to show annual growth north of 50%. Once you get to, let's say, 20 million in revenues, I think anything above 30% is considered really good. And then once you're materially cash flow positive, it's as much about your profit margin as about your growth.
Yeah.
The other thing to consider is the growth of your industry, right? So if you're selling a company in an industry where the average public companies are growing 50%, you should aim to be growing as fast as they are. But if you're in a slow growth industry that's growing 10% and you're growing 20%, then, so it's related to your stage, but also to how fast the world that you compete in is growing. The other thing, if I could add, Iris, I would say a lot of early companies try to do too much, meaning, we could do this, we do this, but we can also do this, we could do that. When you're early, you want to be super, and you know this because you started and sold a company, but you want to be really focused and be the best you could be and be the best at what you do, the best in that subsector. That cuts against the TAM, right, addressable market, but so you don't want your market to be so narrow that it's tiny, but you want to be as narrow as you humanly possibly can until you're ready to go public. Once you go public, then you want to broaden and expand the story. But until you're pretty late stage, you want to be really narrowly focused.
Yeah, I fully agree. This is like the story of my life. I think that what I always say is that it's enough to do one thing right in order to be an amazing company. But it's an everyday struggle because every time there's like a very interesting opportunity. And I can share, for example, with the Rebbe, we started only with marketing analytics, and then Shopify exploded. And we got so many requests for Shopify. And now we have this like e-commerce version, and we have the standard version. And then we start working with Facebook, and we export data to Facebook, and it's working really well, and the feedback is very good. But we found ourselves with like some kind of like 3 versions of the product. But yeah, I fully agree. I also think that like when you look back at all the most significant companies, it was they grew because they managed to do one thing right. So yeah, it's enough. Yeah, I agree.
Well said. Yeah, and yeah, you see that everywhere, and yeah, that's absolutely was my experience. Because folks will say, hey, why, if they have such a good product and they believe in it, why do they need to try to boil the ocean? Why don't they just keep growing what they're doing? So.
Yeah, definitely. Another thing that I would love to hear your opinion, maybe your experience with, is how much do you think it's important for entrepreneurs to build relationships with companies that might acquire their company? I think that one of the key questions that many entrepreneurs have is, should we just build an amazing company and it will come? Or should we go to dinners when there used to be dinners, fly, meet all the strategic people within the company that I know that are pretty much, that are likely to acquire my company? And I know there are very different types of CEOs. There are some that are very, very focused just about the company and the product, and some that network a lot. So I would love to hear your experience if you saw that in some deals it was easier because they already knew the company and the founders, or do you think it's mostly about evaluating the technology and the team?
Yeah, you know, yeah, obviously from a relationship standpoint, you want to build, you know, commercial ties to your likely buyers, because very often the buyer is someone that you have a partnership with. So
yeah,
whenever a CEO or founder has built relationships, it makes it a lot easier. So I think that's important. But the and the personal relationship is very important as well. And but at the end of the day, also, I mean, they are the buyer's buying the team and wants to know that the team, you know, they say, you know, in the music business, you're not buying the song, you're buying the record, and to make the record and to make future records, you need the team. So, so you want the whole band, but it almost always where the CEO or the founder, CTO has had a good relationship with a strategic, that strategic ends up coming to the table. It may take a while, right? But it's if they're spending time with you, there's a reason for it. And you know, when you look on a radar screen, right, as the dot gets bigger, you spend more time with it. So as they spend more time with you, there's a reason for it, and you should be spending more time with them. And but the only exception is I've told companies where those relationships are really good, but they were kind of shackling the company, because if you're a small company and most of your revenue is through one partnership, that partner controls the I mean, it's hard to sell to anybody else, because they can always say, we'll break the partnership. So that you know, not being over reliant on somebody is important, but building those relationships and having a few of those really good relationships in your pocket is critical, I think.
Okay. And if you had to estimate, how many of the deals would you say are initiated by the startup? So, for example, like the scenario that we discussed, we're trying to decide whether to go to a round or to be acquired. We're going to start working with a banker or approach a company directly, as opposed to how many of the deals are initiated by the large companies that decided that this company might be relevant for them.
So I guess the question, how often is there something already cooking, or versus completely de novo? Is that
who usually initiates the initial interaction? Like, is it something that comes from the startup company, or is it something, let's say that when Cisco buys a company, how many of the times is there like exploring new companies and they decide to reach out to the company, and comparing to times that companies want to be acquired or consider it and they approach Cisco?
Yeah, in my experience, most of the time, there's no interest on the table. So I've actually made the first formal approach about M&A, so it's pretty typical. But it's also equally typical that there at least is a prior relationship, meaning the CEO knows somebody that works there. You know, they've discussed the commercial partnership, right? So, but I'm doing a deal right now where the first conversation, like the buyer is a public buyer, and they never even heard of this company. They never spoke with them, and they submitted an offer in 3 weeks. But in that case, I knew that they had a specific roadmap of what they needed, and this company fit perfectly. In fact, in that case, there was an Israeli team working on fulfilling the roadmap, but there was still a lot of work to do. So there was another company with an Israeli tech team that had that other piece of the puzzle. So in that case, it was immediate, you know, love at first sight. So yeah, so most of my deals, there's no M&A involvement with the folks that I talk to, but there often is informal discussions. Like you go to a conference and the CEO, the CTO meet, like at the RSA conference or at Cybertech, right, in Israel, and there's been some prior touch point, and so you know that there's some interest, but not M&A necessarily.
Okay. And Don, can you share some tips about choosing a banker? So if you were in the shoes of a CEO and he or she decide that now might be a good time to meet potential buyers, how would you pick a banker?
Yeah, I'd say if a banker reaches out to you, it's good to take the call. Just, you could say, look, nothing's going on, but, and often a banker will make an introduction or two, and that's how you sort of build relationships. And so when it comes time to pick a banker, you already know a few that have reached out and that have been helpful. And so I'd say ideally, you look to those folks that have been helpful and have spent time with you before. But even if they have, they also have to have the credentials, right? So the best banker for you is someone that you like to work with, number one, but number two, has done deals in your space. Because if they've done deals in the space recently, obviously, they're going to know the space, they're going to know people in the space. So I guess so it's three things. Number one, if they spend time with you. Number two, do you actually like them? And number three, do they know your market? And then you decide. And then you always want to get references from, former clients. It's always, really critical. And I wouldn't necessarily rely on the name. Like recently, we competed against a very large bulge bracket bank, but their expertise was really very minimal. And even though they're a big bank and they have an office in Kuala Lumpur and they do convertible debt offerings, I mean, you as a founder, that doesn't really help you. You want to know, what can you personally do for me, and what's the proof that you can help, right? So that's kind of how you make the decision.
Yeah. And how long would you say it usually takes to understand if there's a good chance that this path will work? So let's say, for example, that you start working with a banker. I guess that the first couple of weeks are more around like mapping the market, start approaching the companies and start the discussion. So do you usually know after like 1, 2, 3 months if you think that the deal is there are going to be offers, or does it take longer? I know that with like these types of companies, they tend to move slowly sometimes.
Right. A good question, Iris. I'd say that after a month, you should know if there's legitimate interest. From that to a bid, I'd say, another month. So I think in 2 months, realistically, you should get the first indication of interest. But after a month, if you're not getting any interest at all, or anybody wanting to talk to management, then it's probably a longer shot, I think. I mean, you never know for sure. I've had processes run a long time, but you'll know in the first month, and you should get bids in the second month. And then within 3 months, you should be under a letter of intent with exclusivity typically. And then 60 days to close. So, that's 5 months. So that's a reasonable expectation. If it lasts longer, it could be for a good reason, because you're managing multiple parties that are doing work. But more often than not, it's not gelling for whatever reason.
Yeah. So. And what would you say are the primary reasons for deals not to close? So let's say that there is interest, things move forward quickly, but then for some reason you don't close the deal.
Yeah, I'd say if it's an early stage company, it's that unfortunately, when you're early stage, you have to be willing to have a little bit of exposure in terms of sharing some technology, demo. You don't let them review the product and see the source code or anything, but at the early stage, I find that companies that want to talk and want to be acquired but are not willing to get into a discussion on the product makes it really difficult. So that's one reason. The other reason is there's a perception that you have a few customers, but I don't think it's going to scale. It's not going to scale because either the product won't scale or the market won't scale the way, and so, you know, a buyer might still be interested, but they feel like there's more risk and they have to do a lot more work to fix the product. And then later stage, once you get to the term sheet, there's only really three reasons. Either something happens with the buyer, something happens with the seller, or something comes back on due diligence that's negative, materially negative. So what does that mean? Materially negative could mean they talk to 3 customers. They almost always want to talk to, even if you're small, they want to talk to 1 or 2 customers. Yeah. And if the customers say, you know, hey, this thing is terrible, right? Or due diligence, you find out that the product has a lot of, you know, shall we say, borrowed intellectual property from others that creates risk of a lawsuit. So that's the reason why it usually doesn't fall apart in due diligence, because usually the buyer knows enough and the seller, you know, they're doing what they say they're doing, and so there's usually not a due diligence bust. It's usually either something happens to the buyer, I've been in a process and the buyer was acquired. I was in a process and the buyer missed their numbers and the CEO got fired of the buyer. So you can't control that, right? And then the only other thing late stage is if there's material adverse change to the performance of the company. And, you know, that's happened where, you know, you said, hey, next quarter we're going to do $3 million in new revenues, and you end up signing 0, right? Even in that case, though, they'll typically retrade and offer a new price, but they won't walk away. So I'd say, you know, realistically, once you sign a term sheet, if you've done it the right way, there's a 80% likelihood you're going to close. And, you know, half of the time, if you're not, you can still go back to the other buyers. You need to do it in the right way. But even in those cases, there's usually someone else at the table.
Okay, interesting.
So,
and
look, and I was going to say, Iris, if someone is considering raising money and they're close to it, I think it's worth spending a month doing the intelligence and seeing what interest is out there. And then you'll know. And then you could decide, do I want to put off the fundraising or not? But you don't have to jump into a full process. You could do it informally for that period of time. And then you'll know who's likely out there and who's interested. And it's helpful actually for fundraising, because investors often will ask, who do you think will buy you 3 years down the road? Yeah. Because they want to know if they can get out of the investment. And if you could say, well, it's funny that you asked that. I just had a conversation with company X. We don't want to sell them because it's too early, but I think they'd be a great buyer. So you can use those conversations to help you in your negotiations when you raise money.
Yeah, definitely. Yeah. Okay. So, Don, is there any other question that I didn't ask? Other interesting things that you want to mention about working with a banker and about this entire process? I think it's really interesting that people speak so much about like how to build the product and the marketing and the sales, but the most important thing about like how to sell your company, this is a topic that is it's really confidential and neglected. It's usually something that is considered to be something that just like happens. So if you have other things to share about it, I would love to hear it.
The one recommendation I'd give to any company is to always run your company and manage it in a way that it is easy for a buyer. And what does that mean? It's simple stuff. It's hire a CFO or an accountant. Always keep your documents in a very good sort of structure. I mean, it's the ABCs of corporate hygiene.
Yeah.
Like always run it as if one day someone will call you and say, hey, we're ready in 30 days. Can we see everything? And so that makes things so much easier and more attractive to the buyer. Right? When you sell a house, you want the house to be clean.
Yeah.
You want the house to be up to date. You want everything, you know, so you'd be surprised, even big companies, they have a separate system that they keep bookings in Salesforce, but it doesn't tie to the financial accounting system. They don't keep corporate minutes. They just, you need to always do that because it'll help you so much when it comes time to raise money or sell. And most companies don't do it actually.
Yeah, that was my experience with our first company. It was very early stage, so there wasn't so much mess, but yeah, we definitely like technology and product, and we neglected the financial side. So yeah, I'm trying to correct it with this company.
Yeah, I'm not sure how long it took to sell your company, but you know, every situation is slightly different. But yeah, ideally, you know, 5 months is the right time frame, I think.
Yeah. Okay, Don, so it's been a pleasure. Thank you so much for your time. Very insightful, and hope you continue working with great Israeli companies.
Thank you, Iris. I enjoyed speaking with you, and you know, keep up the great work.
Thank you.